for more on the outlook for the country. Marcus Bogdan from Blackmore Capital joins us now from Melbourne for his view. Marcus, pleasure to have you on the program today. You've been talking to Australian companies operating in the US. I guess in terms of an Australian company perspective, are there concerns around the US and a potential recession there? And is that impacting investment perhaps into the US, do you think?
Good morning, Ingrid. Yes, well, we are bottom-up investors in Australian companies, and we've just recently returned from the US, speaking directly to US companies, Australian companies, and just seeing on the ground what they are seeing. We saw companies throughout the supply chain. We saw companies in property and media, and the clear message from, and it was very, very general, was that the US economy remains in good shape. Yes, some of the numbers have softened from last year. GDP growth is fallen from sort of 3 to forecasting around 2, but at a company level, companies are still feeling reasonably good in the US market.
And it's interesting because Shane, I've got Shane Oliver here in the studio with me, and Shane, you're not too concerned about US markets and how they'll track going forward. I mean, you're expecting perhaps they'll even move higher by year end.
That's right. I mean, they've gone up far too fast in the last 3 months, and so a pullback is necessary. I think it would be a good thing. But I would agree. You know, if you look at US, I think what worried US companies was all this talk about a trade war and worries about ever rising interest rates from the Fed. Now that there's been a back down from that on both of those fronts to some degree, it takes some of the pressure off. And we were starting to see a decent pickup in business investment in the US prior to the trade war ramping up through the second half of last year. Now I'm hopeful if there is a deal between China and the US, which I think ultimately there will be, then we'll go back to seeing more of a pickup in capex, and that will see the US economy pick up again. Historically, the March quarter in the US is often a soft one. I don't know whether the authorities properly seasonally adjust the bad weather. It gets cold over there in the US at that time, but it's renowned for being weak. And so it's not that surprising that the March quarter so far looks fairly weak, but other indications suggest that it will bounce back. Yeah,
Marcus, what's your take on that? And I guess in terms of having exposure to overseas earners, would you be wanting to have exposure, and if not in the US, or where would you be looking geographically?
Oh, I think we would still favour the US. It's a huge domestic market. It is still growing at long-term averages, and it is so different from what you're seeing in the UK and Europe. And so the companies that we saw in the US were still reflecting very good, solid fundamentals. And so our preference would be certainly at this stage of the economic cycle to favour Australian companies still with significant exposures to the US economy, rather than UK, Britain, or in Asia.
Because Shane, I mean, we talk about asset allocation in this market, and it's key. Obviously, with low interest rates, you know, you look at Australian stocks and how they've been performing, and US stocks potentially in a China slowdown. How would you be allocating funds at the moment? Do you see the Australian market, or equity-wise in the Australian market, a similar story to what you see in the US at the moment? How are you viewing that?
I'd rather favour the US share market over the Australian share market, because I think, notwithstanding a soft March quarter, both the economy and profits, this year we'll see profit growth in the US stronger than we're seeing in Australia. The Australian economy, I think, is under more downwards pressure in terms of growth in the short term than certainly is the case in the US. Obviously, lower interest rates and eventually a lower Australian dollar will help the local market, but generally speaking, we're a bit more confident on global markets than we are on the Australian share market.
Marcus, I know you've been also looking at the healthcare sector specifically. Is this sort of, I guess, taking money out of cyclicals, putting it into more defensive plays? Is this how you're reading the situation in healthcare?
Yes, I mean, there's idiosyncratic reasons why we're looking at particular healthcare companies such as Ramsay and Helios, but we are posturing our portfolio to more defensive assets that are in essential industries and have strong balance sheets, rather than being overweight the cyclicals at this point in the cycle.
Do you think a defensive play is a solid one or a popular one at the moment, Shane, in terms of what we're seeing? And with the yield story playing out how it is in Australia, potentially 2 rate cuts this year, where do you go to find yield? You know, what do you do? Do you go to equities?
I suppose we go backwards to the things that we were looking at before.
Yep.
The yield players in the market, which are still offering reasonably good
Yep.
yields. You know, everyone goes back to the banks or something.
Yep.
But obviously, utilities, real estate investment trusts, they'll probably benefit from that sort of movement down in yields. So that's probably the case. I think, you know, it's funny in a way. You can make an argument that now is a good time for cyclicals globally, and that may benefit Australian cyclicals that have global exposure. But domestically, I'd still be a little bit defensively placed. Resources companies, I think, still have more upside though, because I think commodity prices will stay higher than most analysts have assumed. And later this year, Chinese growth will pick up, which will help our resources stocks. But putting them aside, still a little bit of defensive play, but sort of in the direction of what Marcus is saying, with some exposure to stocks that have a decent global exposure, including to the US economy.
Because Marcus, with rate cuts, and obviously Shane here on the desk expecting 2 rate cuts from the RBA, the market pricing in rate cuts this year from the RBA as well. Yield is a question, right? I mean, it seems like yield will be what investors might be looking for potentially in the second half, perhaps more so than now. Where would they go to find that yield?
Sure. I mean, I think there is, going back and looking at these bond-like equities, we would favour a diverse source of income. I mean, you've got the banks at very high dividend yields, but there's no growth in the dividends. And so we would look to industrial shares where there's still earnings per share growth and hence dividend growth. And also in those major resources companies, BHP, Rio, Woodside, I think if commodity prices stay where they are, you're still going to get very good dividend growth from those types of companies.
All right, Marcus, we really appreciate your time. We'll have to leave it there, but thank you very much for joining us on the show today.
You're welcome. Thank you.